Value has lagged for years, but some investors say the setup is finally shifting. So is this the start of a real rotation or another head fake? Rich Pzena is Co-Chief Investment Officer and Portfolio Manager at Pzena Investment Management. He joins me now. Rich, great to have you at the desk.
Great to be here. Thanks for having me.
So this is an ETF Spotlight. The ETF is the Pzena Large Cap Value ETF, PZLV. We'll get to some of the holdings and whatnot in just a bit, but talk to me about what the catalyst is. What's actually changing that makes now different?
Yeah, well, value investing to most people has been dead for a long time. It's been dead, but particularly in the last decade, where everybody's been enamored with technology, and we really do have a changing world to be enamored with. But value has had a steady, stable kind of growth rate over the long term. So what's really interesting is if you looked at the last 10 years, you would have said value did about the same as the previous 10 years, which is kind of 10 to 12% a year returns. When you look at that from a long-term perspective, you say, okay, if I could guarantee myself 10 or 12% for the rest of my life, I'd be very happy. But it pales in comparison to the growth stocks or the S&P even over the last 10 years or more, actually. So,
do you think that will continue to be the case, though? Because up until really the past couple of weeks, it seemed like value was the place to be.
Yeah, because I think value was doing what it normally did, and the S&P and growth took a little breather. So, I mean, the thing that you have to ask yourself is, you get two kinds of returns from a market. You get the fundamental return by picking a stock and seeing what it earns and the cash flows it delivers over time. And then you get valuation multiple changes. So what's interesting about the entry point today for value is for the last 10 years, the multiple expansion on the S&P and the growth stock index has been quite spectacular. Even though the fundamental returns were kind of normal, maybe a little bit better than normal. Whereas in value, you've had very usual fundamental returns, but the multiples have contracted over the last 10 years. So from an entry point standpoint today, it's about as good as it gets in comparison.
And I think a good place to really home in on is what is value, because it can be broad, right? Are you talking financials, healthcare, consumer? Dig in a bit more, because your ETF is specifically large cap value.
It's large cap value. So the universe is all the large cap stocks. But value, and what I'm going to call value, a lot of people would call deep value. That term didn't exist when we started 30 years ago. There was just value. But today, what's in your mind with value is if a tech stock has gone from
a beaten down stock
has fallen in half, but it's still 30 times earnings, we would be hard pressed to call that deep value. We're looking at things where the multiples of either their current earnings or what they should be earning in a normal environment are single digit kind of multiples. So you get those generally because something's gone wrong. And the pattern is very typical. A company's earnings are chugging along, doing just fine. Something happens, they fall off of that long-term trend, and the market can react negatively, sometimes precipitously so. But the problems aren't always permanent problems. So our whole reason for living is to identify those companies. That's the easy part. The hard part is to make the judgment. Are they actually good businesses? Are the earnings depressed for temporary reasons and likely to rebound? And does the management plan to restore the earnings make sense? Is it a sound, sensible business plan? So that's what we try to find. That's what we do.
Well, give us some of your top names, your top picks, your top holdings.
So I'll pick one for Humana, because it may take me a little bit longer to explain it, because Humana is not on everybody's mind. It's a health insurance company. So the market hates health insurance.
Well, not United Health lately.
Not lately, but if you look over the last 5 years, for sure, it's politically unpopular with Republicans and with Democrats. And Humana in particular is focused on Medicare Advantage. So Medicare Advantage is a supplemental policy or a substitute policy for Medicare. It's one of three big players in this. And if you looked over the last 30 or 40 years, you would call this a growth business. It's a growth business because population is aging, because health costs are rising, and because people have chosen not to be covered by traditional Medicare because it has copays and deductibles, and if you get really sick, you could be in trouble. So people either buy a supplement or a managed care plan, which is what Medicare Advantage is. And it gives you the complete comfort that you're not going to run out of money if you get sick, which you don't get with traditional Medicare. So now about 53% of seniors choose this compared to 0 30 years ago. So the business has been growing double digits for decades. And the margins got negatively impacted by COVID because during COVID, seniors didn't go to the doctor, and so the insurers made a lot of money, and then they got very competitive, which is what happens in these cycles. They enriched their benefit plans, and then everybody started going back to the doctor. So the earnings have really taken a hit. And it's not a high margin business, so it went from a 4% margin to a 1% margin. But the long-term normal is between 3.5 and 4.
So you see it getting back.
What's amazing is if you extrapolated the double-digit growth and the 4% margin, the company's earnings would be close to $50 a share. The stock is in the low 200s. So we're talking about 4 to 5 times normal earnings, even though they're not earning that today.
Okay, so making the case for Humana, I should note, you gave one. I'll give a few of your other top holdings. Citi,
Okay.
Dollar General, Lear.
Right.
But if I'm an investor with broad market exposure, what am I missing by not owning your approach?
Well, first of all, you're missing the fact that you're not diversified. So if you buy the S&P 500 today, you're making a giant bet on technology, and you're making that, and you're entering at a very high multiple. So the odds, even if you had the kind of earnings performance that you've had over the last decade in the next decade, you're starting at a much higher entry point. So the odds of success are just lower. Whereas the Humanas when you can buy something for under 5 times its historically demonstrated earnings rate, the odds are in your favor. So you're and it's, by the way, it's not just health insurance. It's broadly speaking a lot of consumer-oriented companies.
Give us a name that might surprise us that's in the large cap value ETF.
That might surprise you. I don't really have ones that will surprise you because they're the out of favor ones.
Okay.
But here's one, Constellation Brands, okay?
STZ.
An alcohol-related business that has historically been very steady with high margins and giant free cash flow. But there's a downtrend now in alcohol consumption. It's also been exaggerated because they have a high Hispanic population of customers that, because of the crackdown on illegal immigration, have caused fear of going to the bars and going and even being out in public. And so there's been a little bit of a pullback that would allow you to buy this really industry-leading brands across all categories of alcohol at these kinds of valuations.
Yeah, they've called that out on the past couple earnings calls, actually.
Yeah.
So just final takeaways for investors as they think about how much of my portfolio should be focused on value, true value, deep value, versus how much should be focused on growth, because of course the Mag 7 is back in favor, and some might say, why rotate at all? But how should we be thinking about allocation here?
I mean, from my perspective, and this is a totally biased answer, I can show you that over the last 100 years, the 10-year returns of a very straightforward value return have swamped the returns of the S&P 500, because historically the S&P 500 are the biggest stocks, and those, in retrospect, have been the most mature industries, and therefore grown lower than their counterparts and been priced at higher prices. So You know,
So is
I
this a
would tell you,
diversification trade or an outright replacement?
no, it's an outright replacement. And it's not a short-term call, by the way. It's when you're looking at something in the future, like saving for your retirement, saving for your kids' education. If you're an endowment or a foundation that has to fund something for 30 or 40 years, this should be half of your portfolio.
But if rates fall fast, if the economy falls into a recession or the growth rate accelerates,
but you have to have a long-term time horizon, okay? Because if you're trying to make a short-term call, you're right, all of these things matter. They're more economically sensitive. They're more sensitive to things like interest rates. But in the long run, they have comparable growth rates at lower valuations, and that's what gives you the returns.
Okay, well, thank you so much for shedding some light on this space. We really appreciate it.
My pleasure.
That's Rich Pzena, Co-Chief Investment Officer of Pzena Investment Management. The ETF is Pzena Large Cap Value ETF, PZLV. If you're looking for more investment ideas, check out our previous ETF Spotlight on a commodities fund built to hedge against inflation.